Welcome, everyone. My name is Mary Beth Brooks, and I'm the director of the Arkansas Small Business and Technology Development Center at the University of Arkansas. Thanks so much for coming today and listening to us and learn all about SBA lending. The ASBTDC provides complimentary consulting services to small businesses all across Northwest Arkansas. We provide support to all stages of entrepreneurship, from startups to existing small businesses looking to expand, to like long-term businesses needing help with cash flow, and everything in between. We also work a lot with folks trying to buy and sell businesses. As our team has expanded, our vision is expanded. So we really are helping clients in a really unique way than we have in the past. So check out our website at sbtdc.uark, and you can call us at 479-575-5148, or you can email our office at sbdc@uark.edu. Itzel's contact information as well as ours is on the screen right now. Today, we are super excited to have Itzel Meador with us. She is known truly across the state of Arkansas as the expert in SBA lending. She is the director, the SBA director at First Security Bank, with locations all across Arkansas. Here's her contact information, and I'm just going to turn it over to you, Itzel.
Well, thank you. Thank you again for giving me an opportunity to be able to speak to everyone in regards to SBA lending. As Mary Beth said, I am the SBA director here at First Security Bank, and I will say I get a lot of questions regarding how do I know if SBA is a fit for me. So I'm excited to be able to provide some information to just hopefully clarify a lot of questions that people may ask or always have wondered about SBA, and try to simplify it in a way that you can see if this is a fit for you. And like I said, the great part about First Security is that we have options conventionally, but we also have our SBA program available so that we can provide better financing options for our clients whenever they see that SBA may be a better fit. So with that, I'm going to go ahead and start the slides and just give you a little background on SBA so that you have a little better understanding. There's a lot of different SBA programs, but I will say I'm going to predominantly just talk about the SBA 7A and the Express programs. There's also an SBA 504 program that I'll talk about, but the top three, and when it comes to activity with SBA, is the SBA Express, the SBA 7A, and the SBA 504 loans. So I'm going to start the first half regarding SBA 7A and Express. They're basically the same loan. With the name Express, it obviously means it's the smaller version. Where there's always a lot of confusion is what is an SBA loan, because there's so many different types of programs out there. With an SBA 7A loan, it is fully funded by the bank. So First Security Bank, for example, would provide the loan. It is not funded by SBA. There are EIDL loans, PPP loans. Those are completely different. They do not follow the SBA spectrum, so to say. So I want to make sure that's clear to everybody. When you talk to an SBA lender, whoever that may be, they are the ones actually providing you the financing, the money, and all they are applying for is insurance on the loan. So if you were to get an SBA 7A loan, it could be, depending on the loan amount, guaranteed up to 85%. Guaranteed meaning it's insured. So something were to go wrong, we would get as a bank a reimbursement of 85%. If we're going Express, it's a mini version. It goes faster. It only provides a 50% guarantee. So the type of speed that you want sometimes dictates whether you go 7A or Express. And so I'll talk a little bit more about the Express a little bit further down, but I did want to explain that the loan does come from the bank, and all we are asking for is insurance to protect that loan for a variety of reasons, but we will get a reimbursement anywhere from 50 to 85%. We are not basing our loan on what collateral you have. So a lot of times when you come to us conventionally, you may say, hey, I have this piece of property. How much will you loan against it? That's not how SBA speaks. We speak the language of how much money do you need in order to get this business started or to keep the business growing. Whatever your financial need is, we need to know what that is. And if you don't have enough collateral, that is not the reason SBA approves the loan or declines the loan. It needs to know that the loan that you're getting, the business can support. So it is very much a cash flow loan. So anytime that you talk to an SBA lender, we're always going to want to make sure that the loan amount is going to get you from point A to point B, and more importantly, that the business loan can be paid back. The only reason that we have protection on the loan is for a variety of reasons, but one of them is collateral. We typically don't have the amount of collateral that is needed for an SBA, for a traditional loan. So that's why we ask for the protection or the guarantee, so that if we don't get the proper amount of reimbursement when we liquidate collateral, then we can look at our insurance to reimburse us. It allows us to do things we wouldn't normally do, like 100% financing, a lower down payment. So I tell people the SBA loan is typically a conventional loan with a little protection on it. It's not a bad loan that we're trying to make good. SBA will not make a bad loan good. So a guarantee, I tell people, is like insurance. Again, you don't plan on getting in a wreck. You don't get insurance because you know tomorrow you're going to purposely get in a wreck. The insurance is only in place as a worst case scenario. We only want to depend on it if something we didn't predict happens. So that's important for you all to understand when you're talking to an SBA lender, that we are looking at this as a credit decision as a bank, and every bank has their own credit metrics. So make sure you understand what those are when applying for an SBA loan, because again, every different bank may not look at SBA lending in the same way. We all have the same rules, but we all have different credit appetite. Some banks like startups, some do not, but both of them, but a startup is eligible for SBA lending. So I do like to point that out because that can be a little bit confusing. So again, why would you even think about getting an SBA loan? The most common reason SBA lending is done is for capital preservation. Most of the times a client runs into a situation where they don't have as much of a down payment as the bank requires. So that ends up being a top reason to go SBA. We are able to do a 10% down payment on the total project, regardless of the collateral. Remember, that's what we talked about in the first slide. It's about the project. If you've got equipment, working capital needs, and it's $150,000 for your startup, you're only required to put 10% down. So $150,000 loan request, you're asked to put $15,000 on that. So that makes it possible for a client to possibly be able to do this when they only have $30,000 or $40,000 worth of equipment. For existing businesses, this is really popular for some of my clients. They've run into a situation, they want to buy a building and they've been existing for the last 2 or 3 years. I've got a client right now that she needed to buy a building, but if she put the required 15 to 20% down to purchase this building, she was not going to have any cash to operate her business. So I was able to provide her 100% financing for her to buy that building and preserve her working capital. So now she's got operating capital and she could buy the building without tying it all up. And that is where SBA really can benefit a business owner that's trying to expand without using up all of their working capital to buy a fixed asset. There may be a situation where there's additional needs to expand to a different area. And again, if an existing business is a business that's been in place for 2 years or more, this is where SBA may be a better fit because you can do the loan with less money down or 100% financing. The other reason the SBA is really popular is that, again, when we talked in the first slide, I said, if you don't have the right collateral, then the loan could be denied. So if you're asking for $150,000, but the collateral is only $50,000 worth of equipment, well, that turns into being something that the bank can't do. Where for SBA, as long as the loan can show it can be paid back and you need $150,000 and you only have $50,000 worth of collateral, the loan is still possible and still can be done with an SBA protection insurance on it. The other advantage is that we are able to keep the payment as low as possible by providing longer terms. That real estate that I just told you about, I did 100% financing on that purchase of real estate. She also needed to do some improvements, very minor improvements to the real estate, and we were able to do that full loan 100% at a 25-year term. That's better terms than typically can be provided on a conventional loan. If she needed to buy equipment and working capital and combine it all into one loan, that can be done. And then we have a blended amortization. So we may have different uses. We may have equipment, we may have working capital and real estate, but we blend it all together to have one term so that, again, that monthly payment is really low. So the key thing is capital preservation. SBA wants you to keep as much capital in your hand, because if you have more money, you have more chances to grow, more chances to handle whatever economic situation may be happening. So that's the main reason that people go SBA. If you've got a lot of cash and you've got a lot of collateral, the probability of you going SBA is really low. So what kind of things can SBA loans finance? Pretty much anything. Again, we're talking about 7A loans. They can finance, those loans can finance working capital, equipment, leasehold improvements. We can refinance existing debt. There are refinancing rules that we want to make sure that whatever we're refinancing makes a better situation for the business. It's not just for interest rate. It has to do with monthly payment. We want to make sure that monthly payment is going to be a better situation for the client and they have a lower monthly payment or lower debt obligation. It may be situations where you recognize the construction and renovations are going to cost more than the appraisal will support. Those are important to look at. And then one real popular one is purchasing a business. There's a lot of goodwill. There's a lot of value in the business name, but it doesn't have any collateral value. It may be an established business that has a lot of cash flow, but if it's a service business that doesn't have any real estate or doesn't have any equipment, it's collateral short. That makes it very difficult for a bank to finance without some kind of insurance protection. So if the loan crashes, we've got a reimbursement of 75% or 50%, whichever way we're going. So that's a really important tool for us to use SBA when we know we've got a collateral shortfall. I tell people there's clues for a lender to know that there's an SBA note conversation we need to have. Obviously, if you're a startup or you're expanding to a separate location, you better have a conversation with your lender about your SBA financing option. If you're going to your lender saying, hey, I've got some cash flow problems, I'm trying to make my monthly payments, but every 10 days I'm late and I don't know why, I'm trying to figure this all out. It may be that you need to restructure your debt, but maybe that you need some permanent working capital. That's a trigger that you should be talking to your SBA lender or talking to an SBA lender. If you're a growing company, you went from $7 million in sales to $15 million in sales, and you've got a lot of equipment notes that are short, it may be a situation we need to restructure and look at providing you a different type of loan through an SBA program. If you're going into a situation of buying an asset or remodeling an asset and you don't have a lot of liquidity, you don't have a lot of cash, again, if you put everything in, you have no backup, you need to talk to somebody about an SBA financing option to verify that this is really the best way to go. Because if you end up putting too much cash into an asset or into a situation and you later need it, it can really turn into a situation where your business can't recover. If you're a risky industry, there's some companies that are in restaurants, they're in gyms, they're in the kind of industries that maybe a bank does not want. Well, those are the ones that sometimes can't get a loan because the bank's just not comfortable with that kind of industry. That in itself may allow you to get a loan, is that we have protection on that loan. Should it be a restaurant or a gym, we're a little bit more open-minded, knowing that that the right protection is on the loan. If it's a business acquisition, we don't know how you're going to perform once you buy the business, and now the business has a lot of debt. So again, an SBA financing option may be better to give you a better option to grow the business once you take over. There are service companies that don't have a lot of collateral, like if you're a CPA firm, if you do massages or you do any type of service, you typically don't have an asset. So those are really popular for us to look at when it comes to SBA loans. And again, we're able to provide some better terms a lot of times than what we can do conventionally. So those are just clues. If any of these things fit your situation, you better have a conversation with an SBA lender to see what other financing options you may have and not just look at traditional options. It's important for you to know that we have different terms. We go out 25 years for real estate. We do go out 10 years for everything else. So that allows us to really be able to provide a lot of time for somebody to pay back a permanent working capital loan or pay back on an asset that doesn't technically need to be paid back that long, but maybe you need it for that startup or for that growing need. It just allows you to have that lower monthly payment. Interest rates are going to be a little bit higher on the SBA side because there's a lot more documentation. We do have to pay, just like with insurance, you have a monthly premium. We pay a premium to SBA to cover that loan. So interest rates are typically a little bit higher under an SBA, but I'll show you in the next slides that typically the interest rate doesn't keep you from wanting to do the loan if you don't have a lot of working capital, if you don't have a lot of collateral. The interest rate isn't really the biggest topic in your situation. It may be the lower monthly payment that is a better situation that offsets the interest rate. I tell people you can maybe afford a 15-year home mortgage, but a 30-year mortgage just feels a lot better. That lower monthly payment is more important to you. If you really think about it, a 30-year mortgage technically costs you more money, but it helps you out because that monthly payment really allows you to do the things that you need to do. And that's kind of how an SBA loan is. We may be a lot longer and it may cost a little bit more, but it provides you the benefits that you need for your business to grow. I will let you know every deal is a little bit different. So it is important to talk it to your SBA lender to figure out where your interest rate in terms will be. But these are the parameters that SBA provides all SBA lenders. So I talked about the 7A. That's what I call the mama deal, the big program. The 7A pretty much covers everything. SBA came up with the Express. It's the mini version of the 7A. It allows us to do loans that are under $500,000 a lot faster and not require as much paperwork. We can get instant approval as an SBA Express lender. If you're working with an SBA lender that does a lot of SBA loans, such as for Security Bank, we are an approved SBA lender, so we get instant approval and we can move really quickly. The great thing about this program is that currently all SBA fees are waived as long as the loan is under $350,000. So it's a lot cheaper, a lot faster, and we only look at the assets that we're financing as collateral. We may require key man life insurance if it's a situation that we feel like if something were to happen to you as the owner and the business can't, move forward, then we may require key man life insurance. But this is a faster program. It allows us to get money to you much better, but it only provides a 50% guarantee. So not every lender is going to be okay going faster because they may want to go the 7A route, even if it's a smaller dollar, because they get better protection, more insurance. I tell people if you got more protection, it requires more documentation. And therefore, there's a lot more analysis that has to be provided to SBA. Overall, you can look at trying to get an SBA Express loan within 15 to 30 days. If you have real estate, obviously that might be a little bit longer because we do have to get an appraisal on the real estate. So I'm very big about showing examples because I can tell you all about this, but if you don't really see a live case, it kind of makes no sense to you at all. So here's a live case. This gentleman worked for this business. He was only 25 years old. He didn't have a lot of cash to put into the deal. SBA, like I said, does require a 10% cash injection to purchase a business, and he did not have 10%. He only had 5%. So the seller was willing to do a subordinate loan to him. He ended up not being able to get paid on that $12,500, but my client was able to come up with $12,500 to buy the business. And this allowed him to basically have his dream. He was a very smart gentleman. He had all the knowledge about the business. He had all the contacts. He did all the right things. He just didn't have the cash to put down. So he had the $12,500 to put down as a down payment. Obviously, he needed a little bit of working capital to get started, to put some money in the bank account, and he had some closing costs associated with the loan. So we provided him the rest of the funds, the $229,250, and we did it over a 10-year term. I gave him, which is not showed on the slide, but I gave him 6 months interest only to kind of get his feet going and allowing him to get used to being the operator of the business before we put him on P&I payments. But this just is a great example. You can substitute this for leasehold improvements, for anything else, even real estate. It's a startup situation. You still would have to put 10% down, but the client at least can see the benefits of an SBA loan being just one loan, and it's what's the total project. SBA only requires 10% of that, and it would be on a 10-year term. So this is a really good example of a young gentleman who wanted to buy the business he had been working at, and it made it possible. I just talked a little bit more. I didn't realize the slide was right next to it, but it just gave him everything that I just told you at a very low, affordable rate. And he was able to, like I said, get started, and he's doing well. This was over a year ago that I did this loan, and it's a great success story. So the second option was a client, or another example that I had is a client who had been in business for 4 years. He had actually been leasing his business the entire time, but he had a lot of payments. That's why SBA has me look at debt schedules, because I looked at his existing debt, and he had some debt with another bank that was pretty high. And when I got to talking to him, I said, after you buy this building, what are your expectations? And he goes, well, I'm a veterinarian and I need to, buy some new equipment, but I don't have the money for it. So I'm just going to lease the equipment. And I asked him, well, how much is the equipment? And he was like, it's about $50,000. So after looking at his existing debt and knowing he was trying to purchase this building, again, he is an existing business owner, has been in business for 4 years. So SBA was not going to require him to come up with any cash down. So I was able to do a loan for him where he could buy his real estate at $300,000. That other debt that he had, like I said, his payments were really high. They were structured on a short term. I refinanced those debts. I took that equipment he wanted to lease, and I said, how about we buy that equipment and you don't have to have any money down. At that time, there was some SBA fees that were included into the loan. Again, the interest rate was not exciting, but it wasn't bad. It was at 5.5%. Interest rates are a lot higher now, but this just kind of gives you an example that he was very excited about the fact that he was going to buy the real estate, restructure all of his debt, and just have one note. And that one note was going to be substantially lower than what he was already paying in rent payments and debt payments. Rent payments and debt payments, he was paying $9,600, and he didn't own the building and he didn't have that piece of equipment. Now he's paying $6,532. He owns the building. He didn't have to put any money down. He got that piece of equipment he needed, and we were able to get that all to him in one loan. So it was a 16-year term. Remember when I said what's one of the benefits of SBA is that we can blend everything together and give one long-term loan. This is where you can see how it was a difference maker for him. If he had gone conventionally, which was his original thoughts, he would have to come up with at least $60,000 down. He didn't have that. And then he would not have been able to buy the building. And then he would have had much higher payments. He would have had a mortgage payment and his debt payments, because a conventional lender could have not refinanced that debt because there wasn't enough collateral. So this is where SBA can really make a difference for a client. And it's important for you to explore those options because they're out there. The most common misconceptions I get, it's just for people who shouldn't be getting credit. But those two examples that I just showed you, those were very good credits, strong businesses, strong cash flow. They just didn't have the collateral or the down payment requirements. So that's, again, where it's important for us to look at their credit history, look at the ability for the business to be paid back. And it was not startup ventures only. We really helped that other veterinarian get what he needed. And the paperwork, there's only one form that a client has to fill out. It's called the SBA 1919. That's it. The paperwork is really not that intense. I will say the one thing that's really hard for a business owner is that I have to have very current financial statements within 60 to 90 days. So if you don't have an accountant that's handling the finance side of things, then yes, it can be a little bit burdensome, because we do need to have those financials within 60 to 90 days. So I always make sure you are prepared by having an accountant that can keep these financial informations current, and it's easy to get a loan. Again, the government's not the one making the decision of whether they want to do this loan or not. It really is the lender. The lender has to decide how much do they want to do, because there are some loans that a lender is not comfortable with because there's a lot of reliance on the insurance. You know, if you have a $2 million business acquisition and you only have $100,000 worth of collateral, there may be a lot of lenders that get uncomfortable only having $100,000 worth of collateral and a complete reliance on the insurance, which is the SBA insurance. So I always tell people, if you get a no from one SBA lender, go to another one, because they may have different credit criteria, because it's not the government that probably turned you down, it's probably the SBA lender. So those are misconceptions that people have when in regards to SBA lending. Again, we look at everything when it comes to payment of the debt. We may not have the collateral, that's not the issue, but if the business cannot support the debt, and what we consider supporting the debt, if you have $115 of cash available after you pay all of your expenses, and then you have $100 worth of debt, so $115 worth of cash, you have $100 worth of debt, you have 15 cents left over or $15 left over, that's what we're looking at. So we want to make sure that you have some money left over after you pay back your debt. If we're looking at it globally, meaning all your other businesses, including your personal, we want to make sure you are at least covering your cash on and your debt on a one-to-one basis. So that's really important to SBA. If SBA requires down payment, I have to know that you're putting cash into this deal. I have to document that you've had it for the last 2 months and that it went into my transaction. That's the number one reason that SBA loans don't get reimbursed, is because we don't document how the money came and that the money went into the transaction and that you had it for the last 2 months. So that is a big, big deal. And so I always make sure I let the client know we've got to document that immediately. So if I don't see it on your personal financial statement, or you say, I think I'm going to get it, but I don't know where I'm going to get it from, that's going to be an issue for me, because I want to make sure that we don't do all this work to find out that you weren't able to get the cash to put into the deal. I also make sure that if we have to have documentation of projections, the SBTDC is awesome at this. They can give me the information SBA requires. Not only for SBA, when we're basing anything on projections, we got to make sure that we explain to SBA why these projections make sense. How did you come up with that number? What market information gave you the information that you think that these sales are realistic? That is very hard for a business owner. So anytime I know I've got to have projections on a deal, or we're looking at expansion for another project, I always have the SBTDC by my side, because they have market information. They have the ability to really break down where these numbers are coming from and provide me the assumptions that are a requirement. Because again, if I don't have this documented, I don't have the reimbursement from SBA. So I can't tell you how many deals I've had with the SBTDC where they provided me that information, and it was so much easier on the client not having to figure that out on their own, because a lot of times it's a hunch. but you don't actually have the market data to provide that documentation the way SBA requires. So I will tell you that that is a huge asset for us to partner up with the SBTDC. The other reason the SBTDC can be helpful is that clients don't know how much working capital they need. They may buy a business or they may start up a business and they think they need 50 sounds good. They base it on a hunch. They don't actually have documentation of saying, all right, let's see here, month to month, if my business is seasonal, I'm going to need a lot more cash during these months and not as much money on my peak months. So I need to make sure I understand the seasonality of my business. I need to make sure I understand when I might need some working capital, because we may need to set up a line of credit. We may need to give you permanent working capital. But the other reason SBA does not reimburse us on our insurance is that we did not document that working capital was the appropriate amount of working capital for you. It can't just be based on, I think this feels right, or I think 3 months will last me. Well, those 3 months may last you, but you may be entering into 4 months of a very low season because you bought the business during the lowest time of the year. And, let's say it's a lawn care business and you've got no business until the summer and you bought it in the winter. So that rule of thumb of 3 to 6 months may not apply in your situation. So it's really important to break down the monthly cash flow with the SBTDC so we can document. We felt like $50,000 would really help the client if we look at it at a 1-year spectrum and show that it needs $50,000 or it needs $75,000. I much rather provide you what we can actually document than provide you a lot less, because if you don't get the right amount of working capital and you come back to me and things go bad and I'm trying to get my reimbursement from SBA and I didn't document it right and didn't give you the right amount of money, I don't get a reimbursement from SBA because we as a lender did a disservice to you by not providing the proper amount of funds. So again, SBA is really a great way to make a good loan possible, but I cannot do a loan to a client when we look at all of this and say, you can't pay back the loan. That's going to be where I'm supposed to let you know, I can't see the numbers working. This is too much of a loan request for you. So I do have to document that. And if it's a loan that, again, if you've got a lot of cash and you've got a lot of collateral, you could probably get a conventional loan and they may make the decision not based on what your business can support debt-wise. They may just make the loan decision based off what collateral you were providing. So with SBA, I do have to show that if we're doing a loan, it's because we were not able to do that or set up the structure in the same way without additional collateral or without an outside guarantor, etc. I'm not going to go through the 100 reasons that some things are eligible or not eligible. I'm just going to give you an overall of all the businesses that have come to me, the ones that sometimes end up being a problem for eligibility. It's typically that it's a nonprofit. I can only do for-profit entities. If it's a church or some other, daycare that teaches what I would say any type of doctrine, that can be an issue with SBA. So I have to be very careful when it comes to churches or schools that teach a religion or a religious base. SBA does not like to have any kind of discrimination. So that's where religious-based businesses are a problem. If you are one religion and somebody else wants to come into your school, but they're not the same type of religion as you are or the business is, that's discrimination in SBA's eyes. So again, it's all about discrimination more than anything else. They don't want somebody else not being able to come into a business that the government is protecting as far as a loan goes. Franchises are really important to SBA. So if I know you have a franchise, I gotta make sure it's already been pre-approved and evaluated by SBA, or I may have a problem. I don't normally have small businesses that are not considered small. SBA has the alternative size standard, which allows me to pretty much do most businesses. In the 21 years of me doing SBA lending, I've only run into 3 that I did not meet, that did not meet the size standard. And wasn't the business that I was looking at, it was their affiliate companies that they own. Once I tagged it all together, their average income was higher than 5 million, and they had a net worth greater than 15 million. But for the most part, most businesses do not have a $5 million net income and a $15 million net worth. If either one of those situations happen, then it's not considered small. The other common problem I have is if somebody's trying to buy real estate and it's bigger than what their business can support, it's considered real estate investment. So I will say the business needs to be more owner occupied. If you're buying an existing building, you need to occupy at least 51%. If you're building a new building, you have to occupy 60%. But here's the kicker. Your business needs to be able to support the entire debt of that real estate. It is fine that you have tenants, but if you are solely dependent on those tenants to make that payment, SBA will not approve it, because I can't look at outside rental income as a source of repayment ability. That can kick a lot of deals out because SBA will not do real estate investment. I need to know that it's okay for you to have outside tenants, but I need to know that your business can support the debt without the outside tenants. So this is a really important rule that I normally bring up whenever I see a really large building that has additional tenants included. If you want me to refinance, there's a lot of refinancing rules, but I will say sometimes seller notes are asked to be refinanced and they have to be in place for at least 2 years before I can look at it. And another common request that I get is, hey, I want a personal loan so I can buy into a business of 10% or 30% or whatever that case is. That's not eligible for SBA. You have to do a full buyout of the business. So if you are wanting to buy a company, you can't just buy a portion of the company. You have to buy the entire company. So those are the basic ones that I get a lot of, and that end up not being eligible once I start talking to the client. So I wanted to at least point those out to you to let you know if you fit any of those parameters. One thing that I didn't probably list on here is if you're an apartment complex, that's not eligible. Obviously a church is not eligible, but those are things that I also point out. So I'm going to talk to you about a completely different program. So I just talked to you about a 7A, and then the mini version of the 7A is the Express. This program is really popular. In fact, I've got 8 that I'm working on right now on my desk for an SBA 504 loan. This is very specific. It's only for fixed assets. So if you're a client that's wanting to buy a building or wanting to buy a building or construct a building, I've got one in Northwest Arkansas that she's trying to construct a building and buy some equipment and needs some not working capital. She needs some money for the architectural fees, etc. This is the program I'm putting her under. Why? Because it allows for part of the financing to come from the bank, and the other part after the construction is complete comes from SBA directly, and it provides the client with a 25-year fixed rate that I can't match. No bank can match, really. It's a low fixed rate. Right now it's at 5.1% fixed for 25 years. And so this allows my client to not only get our interest rate for half of the loan, but up to 40% of the projects on a fixed rate that SBA provides to the client. And it really can benefit a client on a long-term rate. I mean, a long-term fixed asset that I would not be able to match, especially in this rising rate environment. It can protect a business owner from not being able to afford their building anymore. So I will say that the interest rates fluctuate month to month. I see here on my slide that it says it's currently 3%. That was back in December, so I apologize. It is at 5.1%. The down payment requirement, like I said, is 10%, but there are 2 main questions that SBA asks when it comes to determining the down payment. I actually had this question yesterday. I have a client who is wanting to buy a lake resort. That will not qualify for a 10% down payment. Question number one, is it a startup? If it's a if it's somebody buying a company or buying real estate that they don't currently, obviously they don't own it, but it's a brand new business to them, that's considered a startup. So this person is wanting to buy an existing business, but they don't currently operate that business. So to SBA's eyes, that's considered a startup. So the down payment is now 15% instead of 10%. A lake resort is considered a single-use facility. It's not a multi-use facility. A multi-use facility would be an office building, you name it. Even if it was a restaurant, SBA considers that a multi-use facility because you can turn that into any other kind of company. But there's a single use facility, which I have a list of the kind of companies that are considered single use. A lake resort is one of them. So that client actually would not have qualified for the 10% down payment because it's considered a change of ownership. It went to 15% because it was considered a single use facility. Their down payment is now 20%. The only thing that matters in that is obviously you have to have the cash injection for it, but the down payment, the 50% that we're financing doesn't change. When the down payment changes, the SBA portion goes from 40% to 30%. So our bank will always be at 50%. The only thing that fluctuates is the down payment and how much SBA does. So obviously if you put in more, SBA does less. It's important for you to know that because that may, be a difference maker for this client. It was because they didn't have the 20%. That's why they were coming to us. But 10% obviously is a lot better. That may fit under a 7A. So that's where it's important for me to kind of know the situation, and it may not fit 504. It may be a 7A. 7A does not have the same rules. So the down payment requirement on this situation, if we're looking at 10%, if SBA is doing 40%, I will tell you the bank has to finance the full amount. So when we're looking at a deal, we're financing our part and SBA's part until everything is said and done. So for a short period of time, if it's just a building acquisition, we will have 90%. We will do all the required approvals for SBA, and the CDC is not the Center of Disease Control. It's a certified, I know everybody thinks that, I'm serious. It is for certified development companies. SBA can't do all this by themselves. So they hire a certified development company to handle their money. Basically, they act like it's their money. They do all the paperwork. They get all the approvals. All SBA lenders have to go through a CDC if they're going to do a 504. And like I said, we finance the entire transaction as a bank, but we're working with the CDC so that we can get a reimbursement. And once everything is said and done, we're at 50% if the total project's $1 million, and SBA is financing the rest at a 25-year fixed rate. Sounds complicated, but it's a really popular program, especially for professionals who are trying to buy a building or build a building and try to keep as much money in their pocket and have a low fixed rate. This does not have any kind of insurance on it. It is just a loan that is split up into two sources of funds. That's it. There's no SBA guarantees involved in it at all. So we as a bank need to be comfortable with 50% of the deal, but we know that during a short period of time, we may be out for 90% of it. So we need to be comfortable with the deal at a 90% loan to value. That can sometimes be a little risky. So sometimes the bank will take on additional collateral until SBA reimburses us, and then we release the collateral. So again, pretty much it's a fixed asset project. We can finance land, building, construction costs, any equipment. So it's really popular with professionals because a dentist, for example, in fact, I just did one. I'm refinancing his existing debt because he's expanding his location and he had quite a bit of equipment costs that he was going to include. So we put this all under a 504 and allowed him to have a lower down payment requirement In his situation, we were able to include his existing equity in the building. So he didn't have to come up with additional cash. I just had to show that he's had at least the 10% equity in his building, because we were refinancing his existing debt in order to do this expansion. So we can refinance if it's related to this project and it's been in place for at least 6 months. There's a lot of debt refinancing rules that are complicated under the 504 program. I'll just be full disclosure on that. So if it is something that we're refinancing, it does need to be project specific. There are specific rules as far as making sure I'm not refinancing working capital or things that are not eligible. So I don't want to oversimplify this. If you feel like this is a program you want to look into, please talk with with us. And I would want to double check with the CDC that we're not running into any rules that could keep the debt refinancing from happening. I will say debt refinancing is pretty new to SBA under the 504 program that used to not allow it, but now they've really expanded that program to allow us to restructure existing fixed debt. So it can sometimes be a benefit, because if you've had it for a while and you need some cash out, it used to not be eligible, but now I can cash out to a certain extent. But again, I can give you examples later on. I'm just going to give you the simple example of a real deal where I have a client who purchased a piece of property at $425,000. She is building a building for her optometry facility, and she needs quite a bit of furniture and equipment to go into it because it's 3 times bigger than where she's been. So she's got a lot of expenses associated to that. The great part about the 504 is that I don't need the FF&E to be supported by the appraisal. I just need the appraisal to support the 1.5, the 425,000, the contingency, and the professional fees. So as long as the property pretty much appraises for $2 million, I can do this $2.5 million project, and she only has to come up with 10% down. So this is a huge help for optometries or professionals like a dentist who are in, what I consider a smaller lease location, and now they're about to expand into a big location. What's the problem there? If you go traditional, is that you've got to come up with 20% down, and then the FF&E is something that the bank typically would not finance over a 25-year scope, nor would they provide it to you for just 10% down. So the fact that we can throw it all into one and pay for the, professional fees and do all of that into a deal really makes this program popular for the client. Because then, sorry, I thought I had another slide. It allows them to see what our payment would be under the $1,262,500, and then they will see what the payment is for the $1,010,000 that's with SBA, and they can see those 2 payments are affordable to them. So anytime I do this for a client, I will show them this is what our payment will be. This is what we're thinking the CDC's payment will be. So they will have 2 loans, 2 payments, 2 mortgages, but combined, it should be a lot lower than what they were going to do with a conventional loan, and the down payment requirement is a lot lower. So that's why this program is really popular, especially right now in a raising rate environment. So that was a lot of information, but I wanted to talk to you about the most popular programs, which again are the 7A, the Express, and the 504.
Itzel, thank you so much.
Yeah.
This has been great.
Well, again, if you all have any questions that I didn't go over, I try to give some examples. I have my contact information there. I am more than glad to help in any way.
And those examples, I feel like are super helpful for all of us to better understand. And I've been looking at these kind of things for years, but the example always gives me the next idea as to who could potentially be a client for you or for an SBA lender. So again, everybody can see your contact info here from First Security, and now everybody on the watching this video knows that why I called you the SBA expert. So Anybody who's watching, do not hesitate to reach out to us at ASBTDC for any kind of guidance, or reach out to Itzel and First Security if you'd like to learn any more. Thank you so much.
Thank you.